Welcome. Today we're diving into the fascinating world of dividends and how they impact stock prices. If you've ever wondered why a company's stock price sometimes drops after a dividend is paid or how investors view these payouts, you're in the right place. We'll break down the basics, explore real-world examples, and help you understand the relationship between dividends and stock value. Whether you're a seasoned investor or just getting started, this video will give you a clear picture of how dividends play a role in the stock market. Let's get started by defining what dividends are and why companies pay them. Dividends are payments made by companies to their shareholders, usually in the form of cash or additional shares. These payments represent a portion of the company's profits and are typically distributed on a regular basis, such as quarterly or annually. Companies that pay dividends are often well-established and financially stable, signaling confidence in their ongoing profitability. For investors, dividends can provide a steady income stream, making dividend-paying stocks attractive for those seeking regular returns. Understanding dividends is key to grasping their influence on stock prices, which we'll explore in the next scenes. Companies pay dividends for several reasons. First, it's a way to reward shareholders for their investment and loyalty. Second, regular dividend payments can attract new investors who are looking for consistent income. Third, paying dividends can signal financial health and stability, as only profitable companies can afford to share their earnings. Some firms also use dividends to manage excess cash, rather than reinvesting all profits back into the business. These motivations shape how the market perceives dividend-paying stocks and influence their prices. Dividends come in different forms. The most common are cash dividends, where shareholders receive money directly. Some companies issue stock dividends, granting additional shares instead of cash. There are also special dividends, which are one-time payments often resulting from extraordinary profits or asset sales. Each type of dividend can have a unique impact on stock prices and investor sentiment. Understanding these variations helps investors anticipate how the market might react when a dividend is announced. Dividend announcement date is when a company publicly declares its intention to pay a dividend. This announcement includes the amount, the record date, and the payment date. Investors often react to this news, as it provides insight into the company's financial health and future prospects. Sometimes, stock prices may rise after a positive dividend announcement, reflecting increased investor confidence. However, the real impact on stock price unfolds over the following key date. Record date is a crucial point in the dividend process. It's the cutoff date set by the company to determine which shareholders are eligible to receive the dividend. Only those who own the stock on or before this date will get the payout. This date is important for investors planning to buy or sell shares around dividend time. Understanding the record date helps investors make informed decisions and avoid missing out on dividends. Ex-dividend date is typically set one business day before the record date. If you purchase the stock on or after the ex-dividend date, you won't receive the upcoming dividend. Instead, the seller gets the payout. This date is closely watched by traders, as stock prices often drop by roughly the dividend amount on the ex-dividend date. This adjustment reflects the fact that new buyers are no longer entitled to the dividend. Payment date is when the company actually distributes the dividend to eligible shareholders. On this day, investors receive the cash or additional shares in their accounts. While the payment date is important for those expecting income, it usually has less impact on the stock price compared to the announcement or ex-dividend dates. By the time the payment is made, the market has already adjusted for the dividend. Now let's get to the heart of the matter. How do dividends actually impact stock prices? When a company pays a dividend, its stock price typically drops by about the same amount as the dividend on the ex-dividend date. This is because the value of the company's assets decreases by the amount paid out. Investors who buy after the ex-dividend date are not entitled to the payout, so the price reflects this change. This adjustment is a normal part of the market's response to dividend. Imagine a company's stock is trading at $50, and it announces a $2 dividend. On the ex-dividend date, the stock price will typically drop to around $48. This drop happens because new buyers are not entitled to the $2 payout, so the market adjusts the price accordingly. This example illustrates the direct and mechanical impact dividends have on stock prices, helping investors understand what to expect when a dividend is paid. While the price drop on the ex-dividend date is usually predictable, other market factors can influence the actual movement. Investor sentiment, overall market conditions, and company news can all affect how much the stock price changes. Sometimes, the price may not drop by the exact dividend amount if other positive or negative news is influencing the stock. It's important to consider these factors when analyzing dividend impacts. Over the long term, dividends can contribute significantly to an investor's total return. While the stock price may drop temporarily after a dividend is paid, the steady income from dividends can add up over time. Many investors reinvest their dividends, buying more shares and compounding their returns. This strategy can lead to substantial growth, especially in stable, dividend-paying companies. Dividend yield is a key metric for evaluating dividend stocks. It's calculated by dividing the annual dividend by the stock's current price. A higher yield can indicate a more attractive income stream, but it's important to consider the company's stability and ability to maintain payouts. Chasing high yields without understanding the risks can lead to disappointing results if the company cuts its dividend. Some companies not only pay dividends but also increase them regularly. These are known as dividend growth stocks. Investing in companies with a track record of raising dividends can provide both income and capital appreciation over time. Dividend growth is often a sign of a healthy, expanding business, making these stocks attractive for long-term investors seeking stability and growth. Dividend aristocrats are companies in the S&P 500 that have increased their dividends for at least 25 consecutive years. These firms are often leaders in their industries and are valued for their consistency and reliability. Investing in dividend aristocrats can offer a blend of income, stability, and potential growth, making them popular choices for conservative investors. Companies can change their dividend policies at any time. Increasing dividends often signals confidence in future earnings, while cutting or suspending dividends can indicate financial trouble. The market reacts strongly to these changes, with stock prices rising on positive news and falling on negative announcements. Investors should pay close attention to dividend policy updates, as they can provide valuable insights into a company's outlook. Special dividends are one-time payouts that can have a significant impact on stock prices. These are often larger than regular dividends and may result from asset sales or unusually high profits. When a special dividend is announced, the stock price typically drops by the amount of the payout on the ex-dividend date, similar to regular dividends. However, the market may also react to the reasons behind the special dividend. When companies issue stock dividends, shareholders receive additional shares instead of cash. While this increases the number of shares outstanding, it doesn't change the total value of the company. As a result, the stock price usually adjusts downward to reflect the increased share count. This process is called dilution, and it's important for investors to understand how it affects their ownership and the stock's value. Dividends are typically subject to taxes, which can affect an investor's net return. The tax rate depends on the investor's country and whether the dividend is classified as qualified or ordinary. Some investors may prefer companies that reinvest profits rather than pay dividends to minimize their tax burden. Understanding the tax implications is crucial for making informed investment decisions. Many companies offer dividend reinvestment plans, or DRIPs, which allow shareholders to automatically reinvest their dividends into additional shares. This can be a powerful way to grow your investment over time, as it takes advantage of compounding. DRIPs are especially popular among long-term investors who want to maximize their returns without having to manually reinvest each payout. Investors can earn returns from stocks in two main ways: dividends and capital gains. Dividends provide regular income, while capital gains come from selling shares at a higher price than you paid. Some investors prefer the stability of dividends while others focus on growth potential. Understanding the difference helps you build a portfolio that matches your financial goals. During bear markets, when stock prices are falling, dividend-paying stocks can offer some protection. The steady income from dividends can help offset losses from declining share prices. Many investors turn to dividend stocks during uncertain times for their relative stability and income potential. However, it's important to assess the company's ability to maintain dividends during downturns. In bull markets, when stock prices are rising, dividend stocks can still play an important role. They provide regular income and can participate in price appreciation. Some investors prefer a mix of growth and income, making dividend stocks attractive even when the market is strong. The combination of rising prices and steady payouts can enhance total returns. Dividend trap occurs when a stock's yield looks attractive, but the company's financial health is deteriorating. High yields can sometimes signal trouble as falling stock prices push yields higher. If a company can't sustain its dividend, it may be forced to cut payouts, leading to further price declines. Investors should look beyond yield and analyze the company's fundamentals before investing. Dividend announcements can cause short-term volatility in stock prices. Positive surprises like higher-than-expected dividends can boost prices, while cuts or suspensions can trigger sharp declines. Traders often react quickly to these announcements, leading to increased trading volume and price swings. Understanding this volatility can help investors manage their expectations and avoid emotional decisions. Stable dividends are often valued more highly by investors than high but unpredictable payouts. Companies with a history of consistent dividends are seen as reliable and financially sound. This stability can support higher stock prices, as investors are willing to pay a premium for predictable income. When evaluating dividend stocks, consider the company's track record and commitment to maintaining payouts. Dividend payout ratio measures the percentage of earnings paid out as dividends. A lower ratio suggests the company is retaining more profits for growth, while a higher ratio means more earnings are distributed to shareholders. Extremely high payout ratios can be risky if the company faces earnings declines. Investors should look for sustainable payout ratios that balance income and growth. Companies can return value to shareholders through dividends or share buybacks. Buybacks reduce the number of shares outstanding, often boosting the stock price. Dividends provide direct income. Some investors prefer buybacks for their tax efficiency, while others value the steady income from dividends. Understanding the differences helps investors choose companies that align with their preferences. Investing in international dividend stocks can diversify your portfolio and provide exposure to different markets. Dividend policies and yields vary by country, so it's important to research local practices and tax implications. International stocks can offer attractive yields and growth opportunities, but also come with currency and political risks. Real estate investment trusts, or REITs, are known for their high dividend payouts. By law, REITs must distribute most of their income to shareholders, making them popular among income-focused investors. REIT dividends can be affected by real estate market conditions, so it's important to understand the underlying assets and risks before investing. Preferred stocks are a type of equity that typically pays fixed dividends. These stocks have priority over common shares for dividend payments, making them attractive for income-seeking investors. However, preferred stocks may have less price appreciation potential than common stocks. Understanding the trade-offs can help you decide if preferred stocks fit your investment strategy. There are many strategies for investing in dividend stocks. Some investors focus on high-yield stocks for maximum income, while others prefer dividend growth stocks for long-term wealth building. Diversifying across sectors and geographies can reduce risk. It's important to align your strategy with your financial goals, risk tolerance, and investment timeline. While dividend investing can be rewarding, it's not without risks. Companies may cut or suspend dividends during tough times, leading to price drops. High yields can sometimes indicate financial trouble. It's important to research each company's financial health, payout history, and industry trends before investing in dividend stocks. Dividend-focused exchange-traded funds, or ETFs, offer a way to invest in a basket of dividend-paying stocks. These funds provide diversification and professional management, making them a convenient option for many investors. Dividend ETFs can focus on high yield, dividend growth, or specific sectors, allowing you to tailor your income strategy. Many retirees rely on dividends for a steady income stream. Dividend-paying stocks can provide regular cash flow, helping to cover living expenses without selling shares. It's important to build a diversified portfolio of reliable dividend stocks to reduce risk and ensure consistent income throughout retirement. Interest rates can influence the attractiveness of dividend stocks. When rates rise, bonds and savings accounts may offer better returns, making dividend stocks less appealing. Conversely, low interest rates can drive investors toward dividend stocks for higher yields. Monitoring interest rate trends can help you adjust your dividend investing strategy. When a company cuts its dividend, the stock price often drops sharply. This reaction reflects investor disappointment and concerns about the company's financial health. Dividend cuts can signal deeper problems, so it's important to monitor company earnings and payout ratios to anticipate potential risks. Analysts often update their ratings and price targets after dividend announcements. Positive changes can boost investor confidence and stock prices, while negative updates may lead to declines. Following analyst reports can provide additional context for understanding how dividend news is likely to impact a stock's value. Inflation can erode the purchasing power of dividend income over time. Companies that regularly increase their dividends can help offset inflation's impact. When building a dividend portfolio, look for firms with a history of raising payouts to maintain your income's real value. There are several myths about dividend investing. Some believe only older companies pay dividends or that high yields guarantee safety. In reality, dividend-paying stocks come in all shapes and sizes, and high yields can sometimes signal risk. It's important to separate fact from fiction when evaluating dividend opportunities. Constructing a dividend portfolio involves selecting a mix of stocks with reliable payouts, growth potential, and diversification across sectors. Regularly review your holdings to ensure they continue to meet your income and risk objectives. A well-built portfolio can provide steady income and long-term growth. It's important to monitor your dividend stocks for changes in payout policies, earnings, and market conditions. Staying informed helps you react to news and protect your portfolio from unexpected risks. Use financial news, company reports, and analyst updates to stay on top of your investments. Some common mistakes include chasing high yields without considering sustainability, ignoring company fundamentals, and failing to diversify. Avoid putting all your eggs in one basket and always research before investing. A disciplined approach can help you avoid pitfalls and achieve your income goals. Sum up, dividends play a significant role in shaping stock prices. From predictable price drops on the ex-dividend date to the long-term benefits of reinvestment, understanding how dividends work can help you make smarter investment decisions. Remember to consider company fundamentals, payout sustainability, and your own financial goals when investing in dividend stocks. Thanks for joining us on this journey through the world of dividends and stock prices. Whether you're seeking income, growth, or a balanced approach, understanding dividends can give you an edge in the market. Keep learning, stay curious, and remember that a thoughtful investment strategy is the key to long-term success. Happy investing.